Welcome to the monthly 3-Edge View from the Edge for August 2024. I'm Fritz Folts, the Chief Investment Strategist here, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. Today, as we do at the beginning of each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary research model. There's been a lot going on, so let's get started. The first couple of days of August have been rough for global equity markets. We have weakening economic data in the U.S., which has investors thinking that perhaps the Fed may have indeed waited too long to begin to cut interest rates and therefore may not be able to engineer the soft landing that investors had hoped for. On Friday, the jobs report showed that unemployment in the U.S. rose to 4.3%. That's the highest level of unemployment in 3 years. In response, the yield on the 10-year U.S. Treasury declined by almost 20 basis points. That's a big move in the bond market, down to a yield of about 3.8%. And gold, which is viewed as a haven asset, I believe for the week maybe is up around 4% and up over 20% year to date. So as we turn the calendar year, the month into August, Eric, let's turn things over to you, and let's have you describe first our asset class matrix and tell us what might have changed from July.
Yeah, thanks, Fritz. We can see here on the asset class matrix, we have a couple of moving parts. Things have been pretty stable the last few times we've gotten together here. We're seeing Europe now moving down to that -1 spot, developed Asia, Japan specifically joining Europe, and EM China down there in that -1 spot. So that's moving down 2 notches. And then you have rates that have moved up a little bit, finding duration maybe just a little bit more attractive than we have historically, now that we've seen yields come down like you discussed.
All right, excellent. So let's dig into the major asset classes. We'll begin with the equity markets, and we will start with U.S. equity markets, which, as I mentioned, have had a tough couple of first days of August here.
Yeah, well, July was a volatile month for U.S. equities as well, right? We saw the S&P 500 pull off a small gain. U.S. growth stocks ended with a small loss. Small cap stocks enjoyed one of their best months ever, up over 10%. So there's been a lot of conversation about whether or not there's some great rotation underway. It's possible small cap and value stocks might be preferred, in a declining rate environment, so long as the rationale for those declining rates is because the Fed is declaring victory, right, and moving rates back to a more normal state versus where maybe we're headed based on the economic data you just laid out, a Fed lowering rates because of deteriorating economic conditions. So time will tell ultimately which environment we're in. Our research right now for U.S. equities highlights a mix of both positive and negative factors impacting the outlook. So the projection is nearing a critical inflection point where the outlook could turn more negative. We're seeing declining long yields, which you talked about, and that's very supportive for a positive outlook, at least in the short term. But then you also have this inverted yield curve measure that we've had now for a couple of years in the U.S., along with that level of extreme levels of overvaluation we've been talking about. So that contributes negatively to that outlook. And given that monetary policy operates with a lag, the anticipated Fed rate cuts later this year may be too late to prevent the U.S. economy from experiencing a material slowdown. So a little bit of a mixed bag, but generally still positive.
Okay, great. So let's shift to ex-U.S. equity markets and begin with Europe.
Yeah. The ECB, or the European Central Bank's recent cut and potential future cuts, they too, like in the U.S., operate with a lag. So while these may be potentially beneficial to the outlook in the longer term, it may take some time for this to manifest more positively in our research in the shorter term. So for the time being, European economic growth remains under pressure. We've seen that. We've seen inflation has unexpectedly rebounded recently. So this leaves this outlook for European equities somewhat unattractive for the time being.
All right, let's move over to Asia and the Japanese equity market. What are we seeing there?
Yeah, well, a lot of action here by the Bank of Japan. Their recent action to raise short-term interest rates by 15 basis points, so that brings their short-end rate to just 0.25%, having been at zero or negative for quite some time. And they announced plans to trim their balance sheet over the next few years. This has caused the Japanese yen, their currency, to strengthen significantly in a very compressed time period. So this is going to maybe have some very far-reaching effects as investors who borrow in yen cheaply now are being forced to close those positions, which in turn strengthens the yen further. So over time, the stronger yen is generally going to be a negative for Japanese exporters, which is the dominant type of companies in Japan, and whose products and services now become more expensive abroad. So this is going to lower the attractiveness of Japanese equity investments, which is why our outlook has shifted much more negative.
All right. And so let's look at emerging markets and China. What's the research telling us there?
Yeah, emerging market equities broadly continue to be, plagued or held back by the Chinese equity component. The performance, with broad EM slightly positive for the month, and Chinese equities down for the month. From a recent peak in May, Chinese equities are down over 12%. So the PBOC, or the People's Bank of China, that's the China central bank, they've lowered rates recently in an effort to shore up the economy. But so far, it just seems like market participants aren't really buying it. We've not seen any meaningful changes in the weak domestic consumer spending. The stagnant Chinese property sector still looking quite negative. So the outlook remains negative, but given the recent declines, how aggressive it's been, there is this potential for a rebound in this, what we would define as an oversold condition. So we'll be watching for that to see if that manifests.
All right. And so lastly, in terms of equity markets, let's look at India equities. I get the research, obviously, they are the most attractive, at least on a relative basis, among the equity asset classes. So what are we seeing there?
Yeah, India's equity markets definitely bucked the trend broadly here as they continue to gain in July, up almost 3% in an otherwise challenging month for other equity markets. And that brings India's year-to-date gain for equities, ahead of the S&P 500 on the year, being up over 18% versus, say, 16 and change for the S&P. Our research indicates this continued favorable outlook from measures of positive investor psychology, measures of market momentum. It's still overvalued by our measure, but the positive factors, along with the potential for the Reserve Bank of India, that's India's central bank, to lower short-term interest rates in the near term, just could continue to provide a further boost for this market.
All right. So that will do it for the equity asset classes. Now shift our attention to the bond market and the current interest rate environment, starting with the U.S. Treasury market, where, as I mentioned, had a pretty steep decline in the 10-year yield recently. But what is the model telling us there?
Yeah, it's been U.S. Treasury markets on the longer part of the curve here, longer maturities have definitely struggled. An index of 7 to 10 years just turned positive on the year after July's big downward move in rates, like you discussed. Just for some perspective, the 10-year yield started the year at 3.9%. It peaked in April at 4.7%. And as of the first few days here now in August, it's back to 3. It's 3.8. So a lot of movement there. All while being completely underneath the T-bill rate at 5.25. So, while the path of continued interest rate declines is not certain, our research does support a small increase in overall duration at this time, given some of these moves. And all that said, though, short maturities do provide this more attractive yield and remain at a better risk-adjusted position on the yield curve. So the majority of client fixed income holdings would be on that shorter side still.
All right. Let's look at the corporate bond market, referred to often as the credit markets. What are we seeing there in terms of the model?
Yeah, not a lot of change here. With regard to credit, we believe the risk of an economic slowdown is not being priced into credit spreads. They remain near historic tight levels, making the trade-off of taking on credit risk not worth it, really, in our opinion, relative to investments in risk-free treasuries. So still cautious.
All right, great. So let's shift to real assets or hard assets, including gold and commodities. Why don't we begin with gold, which is having a pretty strong year this year?
Very strong year so far in 2024, up almost 19%, maybe 20% by your measure, and over 5% in July alone, right? So, it's been benefiting from our measures of positive investor psychology, momentum measures, an increase in central bank purchases. We've seen, of course, rising political tensions and short covering, which helps boost it as well. And then on top of all that, the prospect of a decline in real, that is inflation-adjusted interest rates, should the Fed start lowering, and should that impact real rates, that could also further support continued gains in the price of gold. So the outlook definitely remains favorable here.
Okay, and what about the other part of the real asset marketing? Look at commodities. What's the research telling us there?
Yeah, I mean, the general outlook remains somewhat positive. We're seeing rising global geopolitical tensions, conflicts. That supports the potential for crude oil price increases. That's a dominant component in broad commodity indices. While a weakening global economy, particularly in China, acts as a headwind here too. So generally speaking, a little bit more positive than negative, but somewhat neutral. Should the value of the U.S. dollar decline as the Fed prepares to lower rates, dollar-denominated assets like commodities may benefit.
I've seen the price of oil come down here too, right? A bit, sort of softening. So we'll see what happens there.
That's right.
All right, Eric, great. Thank you. That is the update of our current outlook for the month of August. That will do it for this month's 3-Edge View from the Edge. Eric and I will be back in early September with another edition of the 3-Edge View from the Edge. If you would like a hard copy of our full View from the Edge newsletter for this month, you'll find that on our website, 3edgeam.com. And as a reminder, our entire library of video content is always available on our 3Edge YouTube channel. If you think that someone you know might benefit from our videos, please feel free to share them. So, on behalf of Eric and everyone here at 3Edge, thanks for listening.